if you are single and getting the age pension, or if you are part of a couple. I need you to listen carefully for the next few minutes, because this affects your money directly, right now, not in some future year. Thousands of Australian pensioners believe that couples automatically get double what singles get. That is wrong. Thousands of singles believe they are always worse off than couples. That is also wrong. The real answer sits somewhere in between, and it depends entirely on your own numbers, your assets, your income, and your living situation. Getting this wrong is not a small thing. It can mean missing out on money you are legally entitled to. Or worse, it can mean walking into a debt you never saw coming. My name is John, and this is Centrelink Support Hub. Before we go any further, I want you to know something. You are not alone in feeling confused by this. I read your comments every week. I hear from singles who feel like the system has forgotten them. I hear from couples who feel like they are being punished simply for being married or for choosing to share their life with someone. Wherever you sit in this story, John is right here with you. Whatever your situation is, we are going to work through it together, step by step in plain English, with no confusing jargon left unexplained. Here is my promise to you for this video. I am going to walk you through exactly how the rules treat singles differently from couples. I am going to use the real numbers, not rounded guesses, not vague estimates, but the actual figures published by Services Australia. By the end of this, you will know exactly where you stand and what to go and check for yourself this week. And before we dive in, I want to ask something of you, because this channel only works properly when it is a two-way conversation. Today, I want to consult with you. I read every single comment myself, and I reply to as many as I possibly can, because it genuinely means something to me to hear directly from you. So while you are watching this, I want you to tell me your exact situation in the comments below. Are you single? Are you part of a couple? Has your payment changed recently and you are not sure why? I will look at which topic comes up the most this week, and my very next video will be built specifically to solve that problem. You tell me what to make, and I will make it for you. Now, let's get into the numbers, because this is where the real answers live. Let's start with the simplest question anyone can ask. How much does a single pensioner actually get, and how much does a couple actually get? These are the base payment rates, current from the March 2026 indexation, and they carry through as the foundation for everything else we talk about today. A single pensioner on the full-age pension receives $1,200.90 a fortnight. Over a year, that works out to roughly $31,200. A couple together receives $1,810.40 a fortnight, combined between the two of them. Now here is where a lot of people get tripped up. Some of you will have already done the maths in your head and thought, wait a minute, that is not double the single rate. And you would be exactly right. It is not. Split evenly between two people, that couple's combined payment works out to $905.20 each per fortnight. Let's say that plainly, because I want this to sink in properly. A single person receives $1,200.90. Each person within a couple receives $905.20. That is a difference of almost $300 less per person every single fortnight, simply because of relationship status. If that feels unfair to you, I want to be honest with you, rather than just reassuring you for the sake of it. This is not a mistake. It is not some kind of system error or oversight. It is a deliberate design choice built into the rules, based on one central assumption. The government assumes that two people living together share their costs. One power bill instead of two. One rent payment or mortgage instead of two. Groceries bought once, in bulk, rather than twice over. So the system pays a lower rate per person because it is built on the idea that you are not paying for everything twice. Whether you agree with that underlying assumption is a completely fair thing to have strong feelings about, and I know many of you do. But whether you agree with it or not, understanding that it exists and understanding exactly how it plays out in dollars and cents is the first step to planning your finances properly around it. Now let's move into the part that causes even more confusion, because this is where the real gap between winning and losing starts to appear. This is the assets test. From the 1st of July 2026, if you are a single homeowner, you can hold up to $333,000 in assessable assets. And remember, your own home is not counted in this figure, and you will still receive the full pension. If you are a homeowner couple, that combined limit is $499,000. I want you to stop for a moment and really look at those two numbers. $499,000 is not double $333,000. It works out to roughly 1.5 times as much, not 2 times as much. So here's the trap that catches so many couples out. A lot of people assume that because there are 2 people in the household, they automatically get twice the allowance that a single person gets. They do not. The system gives couples some extra room compared to singles, yes, but it is nowhere near double. If you are a non-homeowner, these numbers shift upward because your home is not sitting there as an already exempt asset working in your favor. A single non-homeowner can hold up to $600,000 in assets and still receive the full pension. A non-homeowner couple combined can hold up to $766,000. Once your assets move above that lower threshold, your payment does not simply stop or fall off a cliff straight away. It reduces gradually. For every $1,000 you are over the limit, your pension reduces by $3 a fortnight. This taper rate applies in exactly the same way whether you are single or part of a couple. The only real difference between the two groups is where that starting line sits. If your assets keep climbing, there is an upper cutoff point too, where the part pension stops altogether. For a single homeowner, that cutoff sits at $733,500. For a homeowner couple combined, it sits at $1,102,500. For non-homeowners, those cutoff figures are higher again because of that missing exempt asset I mentioned earlier. Now let's move to the income test, because this next part is the one I received the most confused comments about. And I really want you to listen carefully here, because it catches genuinely well-meaning people off guard. From the 1st of July, a single pensioner can earn up to $226 a fortnight before their pension starts to reduce at all. A couple, combined, can earn up to $396 a fortnight before their combined pension starts to reduce. Once you go over that line, here is what happens. For a single person, the pension drops by 50 cents for every extra dollar earned above that threshold. For a couple, it also drops by 50 cents combined for every extra dollar earned above their threshold. But that reduction is split as 25 cents off each partner's individual payment. Now here is the trap I really need you to hear clearly, because it is the one that generates the most confused and frustrated comments on this channel. If you are part of a couple and your partner picks up some extra shifts or receives a small pay rise or starts a modest side income doing something like gardening work or babysitting for the grandkids, that does not just affect their share of the pension. It affects yours too, even if your own personal income has not changed by even one single dollar. I want you to genuinely sit with that idea for a moment, because it surprises a lot of people the first time they hear it properly explained. You could do everything exactly the same as you did last year. Same routine, same spending, same lifestyle. And your own payment could still go down, purely because your partner's income went up, not because of anything you did. If that sounds like a penalty for working hard as a couple, I want to say clearly, it is, because it functions exactly that way in practice, even if that was never the stated intention behind the rule. Now let's talk about deeming, because this word confuses almost everyone the first time they hear it, and it applies differently depending on whether you are single or part of a couple. Deeming is simply the government's assumption about how much income your savings and investments are earning, regardless of what they actually earn in real life. Think of it like this. Even if your money is sitting in an account earning very little interest, Centrelink assumes it is earning a certain rate anyway, and counts that assumed amount as income for the purposes of your pension. For a single person, the first $64,200 of your financial assets is deemed to earn 1.25%. Anything above that amount is deemed to earn 3.25%. For a couple, the first $106,200 of your combined financial assets is deemed to earn 1.25%, with anything above that deemed at 3.25%. Notice again that the couple's threshold is not simply double the single threshold. It is higher, yes, but not by a full doubling. This is the same pattern we have seen throughout. Couples get more room than singles, but proportionally less than you might expect. Now let's talk about the work bonus, because this is genuinely good news, and I want to make sure you understand how it applies differently for singles and for couples who are still working. The work bonus allows you to earn up to $300 a fortnight from employment, without that amount counting towards your income test at all. If you are single, that is $300 of protected income for you. But if you are part of a couple, and both of you are still doing some paid work, each of you individually gets your own $300 exemption. That means a working couple can potentially have $600 a fortnight in combined income that is protected from the income test altogether, because the exemption applies per person, not per household. This is one of the few places in the whole system where being a couple genuinely does give you closer to double the benefit that a single person receives, rather than the reduced, shared cost version we have seen everywhere else. Now I want to address the myth that comes up more often than almost any other topic in my comments section. Some of you have written to me suggesting that if you simply apply as single with Centrelink, even though you actually have a partner, you would receive the higher single rate and come out ahead financially. I need to be completely straightforward with you about this, because getting it wrong here is genuinely serious. Centrelink's definition of a couple is quite broad. It includes people who are legally married, people in a de facto relationship, and people in a registered relationship. In certain circumstances, it can even apply to people who are not living under the same roof, if the nature of the relationship meets the criteria Centrelink uses. If Centrelink later determines that you were in fact in a relationship while being paid at the single rate, they do not simply correct your payments going forward from that point. They go back to the very day your payments began at the incorrect rate, recalculate the entire amount based on the correct couple rate, and raise a debt against you for the difference. This can add up to a genuinely large sum of money, and it comes with real stress attached on top of the financial burden. This is not a small technicality buried in the fine print. This is, in my view, the single biggest mistake I want you to walk away from this video, understanding clearly. Getting your relationship status accurately recorded with Centrelink is not optional, and it is not something to leave ambiguous or hope goes unnoticed. It is the foundation that every other calculation in your pension is built upon. If that foundation is wrong, everything built on top of it is wrong too. Let me walk you through a simple example now, purely to help make all these numbers feel real rather than abstract. I want to be clear that this is a hypothetical illustration, not a description of an actual person, just a way of showing how the maths plays out in practice. Imagine two different households. The first is a single pensioner who owns their own home outright, with $300,000 in savings and other accessible assets. The second is a homeowner couple, also with $300,000 combined in accessible assets. The single person, sitting at $300,000, is comfortably under their full pension threshold of $333,000. They receive the full single rate of $1,200.90 a fortnight. The couple, also sitting at $300,000 combined, is well under their much higher threshold of $499,000. They also receive their full combined rate of $1,810.40 a fortnight. Now split that couple's payment between the two of them, and each partner receives $905.20. So even with exactly the same total household assets, the couple ends up receiving less per person than the single pensioner does, purely because of how the payment structure works, not because either household has done anything differently or incorrectly. This is exactly why I always encourage people not to simply compare their total household income or assets to a neighbor's or a friend's situation. You need to compare your situation properly using the specific test that actually applies to your circumstances, because that is the only way to genuinely know where you stand. Now I want to share something that surprises a lot of people, including some financial advisors who deal with this less frequently than you might expect. This is one of the few genuine upsides hidden within these rules for couples. If you are part of a couple and one of you moves into residential aged care due to illness, you can apply to be assessed as an illness-separated couple. Under this arrangement, your combined assets are still assessed together as normal, but each of you is then paid at the higher single rate, rather than the reduced couple rate, in recognition of the fact that you are now effectively running two separate households instead of one. This means that instead of receiving $905.20 each, you could each receive $1,200.90, a genuinely meaningful increase, and one that arrives at exactly the time when the extra money is most needed, given the costs associated with aged care. But here is the important catch, and I want you to hear this clearly. This adjustment is not automatic. Centrelink does not apply it on your behalf simply because your living situation has changed. You must actively report the change and specifically request the reassessment under this rule. If you are not aware this provision exists, you could be missing out on genuine, ongoing money every single fortnight, at a time in your life when every dollar matters more than ever. I also want to briefly mention rent assistance, because it interacts with these thresholds in a way that is easy to overlook. If you receive rent assistance alongside your pension, your asset test cutoff point is actually higher than the standard figures I gave you earlier. This applies to both singles and couples, so if you are renting and receiving rent assistance, it is worth specifically checking your own cutoff point through the Payment Finder tool or by speaking directly with Centrelink, rather than assuming the standard figures apply to you. Let me now give you 5 simple, practical things to check this week based on everything we have covered. Rule 1. Confirm that your relationship status is accurately and honestly recorded with Centrelink today. Not next month, not eventually, but today, because everything else depends on this being correct. Rule 2. If you are part of a couple, remember to think about both partners' income together as a combined figure, not separately, because that is genuinely how Centrelink assesses it, and thinking of it any other way will only lead to confusion later. Rule 3. Take the time to know your correct threshold for your specific situation, whether you are a homeowner or not, whether you are single or part of a couple, and do not simply assume the figures. Go and check the actual current number for yourself. Rule 4. If your living situation changes in any significant way, particularly due to illness or a move into aged care, report that change to Centrelink straight away. As we discussed, this could actually increase your payment, not just protect it from an accidental error. Rule 5. If anything remains unclear after watching this, pick up the phone and call the Older Australians line on 132 300 and specifically ask to speak with someone from the Financial Information Service. This service is completely free, and it exists precisely for situations like yours. I want to leave you with this thought before we finish up today. You worked for decades through good years and difficult ones to build the life you now have. This pension is not a gift being handed to you out of charity by the government. It is something you are legally entitled to under a specific set of rules, and that is exactly why it is worth taking the time to understand those rules properly, rather than simply hoping everything works out correctly on its own. So, coming back to the question in our title today, who actually wins under the new July rules, singles, or couples? The honest answer, and I promised you honesty rather than a simple, satisfying soundbite, is that there is no single winner across the board. It depends entirely on your own assets, your own income, and your own living situation. There is no universal answer that applies to everyone watching this video. There is only your specific situation, and whether or not you fully understand how these rules apply to it. And that is exactly why I want to hear from you right now. Tell me in the comments below. Are you single or are you part of a couple? Has something about your payment changed recently that you have not been able to explain? I genuinely read every single comment, and whichever topic comes up the most this week will become the subject of my very next video on this channel. Thank you so much for watching today. Take care of yourselves, look after each other, and I will see you in the next one.